I'm Ashton Addison from Blockwest Capital for Investment Pitch Media, and today on the Crypto Coin Show we have Filipe Goncalves, the head of DeFi at Ankr. Filipe, welcome to the show, and thank you for taking the time.
Hey, thank you for hosting me.
You're very welcome. We've had Ankr on the show. I'm really fond of your guys' liquid staking solutions, and I'm fascinated at learning about all the functionalities and capitalization that people can do with their tokens while they're staking, and more DeFi functionality seems to be coming out and extrapolating value in different ways as the DeFi sector continues to grow. And I'm excited to hear the updates from our last talk and how Ankr continues to grow. I know it is one of the biggest and best staking solutions. So first of all, for those who haven't seen the first interview with Ankr, let's just dive into what is Ankr focusing on as your main blockchain and staking solutions, and then we'll dive into all the recent details.
Yeah, sure. So Ankr is fundamentally focusing on the nodes, and we started our journey with full nodes and validator nodes, and at the time we were helping developers to deploy nodes easily without relying on cloud solutions. As that services are becoming commoditized, we integrated vertically on the validator node side by creating liquid staking. So Ankr is actually a pioneer in liquid staking, and it created ETH liquid staking in December 2020. So it was actually the first project to go to market with that solution. And on the RPC node side, we evolved into blockchain APIs until a point where we realized that we were kind of centralizing decentralized information, and that this is fundamentally, for the sake of consuming blockchain data faster and more easily, well, then you end up centralizing the network. So we took a step back and we decided to build a network of RPC nodes. So now we support 16 chains for developers, and the main advantage is that it is more reliable because the nodes are not operated by Ankr; they're operated by Ankr and other node providers, and it also reduces latency because we have a very wide network of nodes operated in Latin America and Australia. So if you're an end user located in Australia, obviously you're going to get information much faster from the blockchain if you're consuming from a node that is also located in Australia. Mm-hmm. So our aim is really to be the largest network of RPC nodes, so that we can really then have a competitive advantage when selling our advanced APIs with lower latencies than most of our competitors. And more importantly, for users that are not necessarily located in the big spots, right, like US, Europe, and so on, and for users in other regions, they can still benefit from very low latency services.
Mm-hmm. Fascinating. And I like that you're also focused on that centralization issue and making sure that things don't become too centralized or imbalanced. And I'm seeing in the news recently with this merge to Ethereum 2.0, there are some discussions around the centralization of Ethereum and clusters of it in the USA and jurisdictions. And I feel like that's not a good sign for a blockchain when now there's discussion of centralization. So I'm glad that that's a focus for your group. Now, liquid staking and just staking in general, where anybody, some end user or beginner to crypto can stake their tokens and get a little bit of a reward, it is great because you're just holding the tokens anyway. But I'm curious about the node infrastructure that you're talking about. Are you seeing, or what kind of clientele are you seeing open up these nodes? And is there an advantage for people that are just used to and only understand regular staking or liquid staking to move into staking and actually running a node?
Yeah, so I think here there is obviously different players, and I think validators and, let's say, major delegate stakers for other chains. So on Ethereum, you need to be a validator. You cannot really do delegate staking in itself, but in other chains you can. So I think maybe the difficulty with liquid staking is that it doesn't offer necessarily higher rewards when compared to just running a validator node or being a delegate staker. However, it does have some higher smart contract risk. And basically, currently, you basically need to convince users to bring more financial services in DeFi and more utility for liquid staking, so that it really convinces them to outweigh the higher risk of smart contract risk, right? And currently, I think the industry kind of fell into that situation where it creates use cases for liquid staking, but it makes it very much dependent on farming rewards, right? So I think we saw it with the liquidity pools on Curve for STETH, for example, where it's obviously made to provide instant liquidity for Ethereum liquid staking because it's not redeemable, right? At least not for now. We still need to wait a few months until we see the Shanghai update for Ethereum transition. And here the issue is that there is a few things that are capital inefficient for liquid staking, right? So the example of liquidity pools, I think it's very easy to understand, where if you stake Ethereum, you can get about 4%. But if you deposit liquid staking into a liquidity pool, well, then you have half that is in liquid staking still earning 4%, but the other half is in Ethereum. So then you're kind of giving away half of your rewards. And then your expectation is that the trading fees and the farming rewards need to at least compensate your loss of half of the rewards, of the staking rewards, so that you make it at least as appealing by just, instead of just staking. Obviously, while there is an additional layer of DeFi composability, higher smart contract risk, so then you expect to see higher rewards. And we didn't really see anyone in the space trying to tackle those challenges and those difficulties and inefficiencies. And it's just taking the shortcut of just giving away farming rewards, which is something that we've been trying to avoid, not only because of the sake of building things that are capital efficient, but also because our Ankr token is mainly used as a utility token for our RPC node network, and we want to use it responsibly and not dilute it heavily just for the sake of attracting TVL that can be very temporary, because other liquid staking solutions are actually redeemable, such as the case of BNB. So if you give amazing rewards right now, it doesn't mean that the TVL is going to stay in 1 month.
Fascinating, Filipe, and I'm glad that you mentioned other chains like BNB, because what I'm most familiar with is the Ethereum staking and something like STETH on Lido, where you can get a token in collateral, but because of the ETH merge, staking your Ether, it's sort of stuck in there and it's not really redeemable, whereas other blockchains it can be. And the yields are different, and sort of the way that, you know, the functionalities that you could use with different tokens that you can get while you're staking. Say you get a liquid token, you're able to use that in other ways to capitalize further. And I'm curious about BNB, as you mentioned, and perhaps some of the other chains. How does that work on Ankr compared to Ethereum? And, you know, are there great incentives for everybody to be staking their BNB on Ankr specifically?
Yeah, so I think like with Matic and BNB, I think it's interesting examples where on Ethereum, what we're doing is delegating validation keys to a group of nodes. And for Matic and BNB, because it is delegated proof of stake or delegated proof of authority in the case of BNB chain, it's actually easier in terms of architecture because you already have functional validator nodes, and your job as a creator of a liquid staking solution is just to delegate stake to existing validators, and you just try to make sure that you delegate stake to validators that make sense, that are not going to get some slashing, where they offer a decent APY. So fundamentally, it's the only thing that we do, and then we offer to the users a liquid staking token. So the biggest difference is really that it's redeemable. So you need to see it a little bit like a primary market and a secondary market. So the DEXs are the secondary market, and Ankr in our case is the primary market. So when you stake your BNB with Ankr, you get the liquid staking token. You have a redemption price, right? So it is something that gets updated every day, and it goes up on a daily basis. However, then if you want to sell, you can unstake and receive the underlying asset in about 7 to 10 days. However, you can also sell it immediately in a DEX, and that's the difference with the secondary market. It might have a price that is not necessarily the same as the primary market. So if you're very impatient and you want to sell your tokens, well, then you should go to a DEX. And obviously, it's not just for satisfying the needs of people being impatient. Instant liquidity indexes is very important to make it acceptable as a collateral. So one of the big use cases of liquid staking is to do leverage staking, right? Is the ability to use as a collateral the liquid staking token and borrow other assets to take leverage, such as the underlying asset. And you still see some interesting things, right, on Matic and BNB, and even on Ethereum, is that the lending interest is significantly lower than the staking rewards. And in the case of Matic and BNB, the additional liquidity risk of staking is obviously higher than lending in Venus or Aave, but the difference in yield is still very significant. So, and that's the cause of the problem, if you look into it, is more because of the interest rate model of Aave that is actually not really indexed and adapted to staking. So it does not consider the staking rewards as a reference rate, right? So, and I think fundamentally that's the issue, where you see like such a huge difference of, for example, 1% lending interest on BNB while the staking rewards is 5%. And like, doesn't really make sense, such a big difference when the rewards, the unbundling period is only 7 days. So we partner with projects such as Midas Capital, for example, to try to solve that kind of issue with isolated lending, where we basically created a market where we index the BNB staking rewards APR to the interest rate model of BNB borrowing to make sure that at the optimal level, the BNB borrowing interest is the same as the staking rewards. So it always makes it profitable for people to do what we call liquid staking folding strategies, which is the process of just depositing BNB liquid staking, borrowing BNB, and then you deposit more BNB liquid staking and you repeat the operation. So we believe that indexation is very important and is something that is not really being used, and it's very important to trigger a convergence between liquid lending interest and staking rewards, because fundamentally there isn't a very, very big reason to see a significant difference between both rates.
Super fascinating, Filipe. And so from what I understand, because of the liquid staking, you can stake your BNB, get the liquid BNB, and then use that as collateral to just borrow more BNB and stake it and sort of continue the process. And there is sort of that, not exactly arbitrage, but arbitrage opportunity where there's 1% interest and 5% staking reward. I would think if enough people did that, it would sort of lower, those numbers would converge, as you're saying, and the opportunity would be smaller. But I feel like, and I always press urgency on people that are new to trading or staking about using leverage, that there's obviously more risks involved if you're staking up something and getting collateral, and there could probably be risks there of perhaps if the price of BNB crashes, or maybe there are other risks. Is this something that everybody should be doing, or what do you see as the risks and rewards from this situation?
There is obviously a risk, but I will say it's more a liquidity risk. So The liquidity risk is that you need to wait 7 to 10 days potentially if you really want to unstake, and in case you don't see an acceptable price on the secondary market. So it's not necessarily something for everyone, but if you do have the patience to bear that illiquidity risk is something obviously that can be considered depending on everyone's personal situation. I will say that also having participants that do that kind of strategy, it also increases the BNB borrowing demand, which increases also the lending interest for BNB, which then creates an alternative to staking, which is more liquid, which is just lending BNB, but then giving a rate that is maybe not 1%, but maybe 3.5% instead of 5% for staking. So that's also something that can also, an alternative that creates like a different risk profile that can attract other people to indirectly participate into liquid staking. There is other benefits. For example, the concept of a folding strategy is originally the process of just, for example, depositing Matic on Aave, borrowing Matic, deposit Matic, borrowing Matic, but the thing is that it was only enabled because of the farming rewards. And if you look into these peer-to-peer lending platforms, you still see that they still give farming incentives on the lending side and on the borrowing side. And they do that because they need to trigger like a minimum demand, a minimum utilization level to make the product attractive enough. With liquid staking, you actually no longer need to have that kind of farming incentives because you just use the proof of stake rewards. And then you just create natural demand for Matic borrowing and BNB borrowing because you can just liquid stake instead.
Fascinating. And where do you see today how popular liquid staking is becoming? From what I'm aware, with Ethereum, quite a large percentage of the total supply of Ethereum is now being staked. Are you seeing people how's the growth of the liquid staking on Ankr over the past few months, despite the market conditions?
So I think for liquid staking, I'm not sure we're really seeing like a lot of new DeFi advanced users into the market. And I think this kind of use cases is obviously good for DeFi users, but I think the future growth is mostly going to come from B2B use cases. So I believe, for example, if for example, KuCoin Earn, Binance Earn decides to create some BNB Earn strategies, obviously they can use just BNB liquid staking as an infrastructure, or it can just be one strategy among like a basket of strategies that they're running. So they could also decide to just do 80% staking, 20% lending, which is something that is a little bit more liquid, because whenever someone wants to redraw, they have that 20% buffer that they can take from, right? So that kind of composable strategy is something that I believe will be used by B2B players more and more. And liquid staking, it just makes it very easy to integrate in such strategies. There is obviously other liquid staking providers. So I think that kind of composable strategies proposed by B2B players will be very important for, let's say, the upcoming volume of TVL. And this is what we expect. One example that we see on BNB liquid staking, we're currently the leaders there. And our strategy was different, not so much focus on the farming rewards too much, but more in partnerships. So we partnered with a project called Helio, and their purpose, it was to create yield. It was to extract yield from a volatile asset such as BNB, liquid staking, and give it and transfer it into a stable asset. So to basically allow people to generate yield, but with a stable asset, with a stable value versus US dollar. So this is something that they've been doing. And obviously, because they're using BNB liquid staking from Ankr, most of their TVL became our TVL as well.
Mm-hmm.
right? So that was actually very helpful, and that's actually contributing for about 80% of our TVL currently. So that's that kind of strategy that we believe actually will make more sense, at least for Ankr, is really to use liquid staking as an infrastructure tool for individuals, for institutional investors, but also for other protocols if they want to build on top of it.
And as Ankr continues to grow, is that part of the focus to partner with some of those exchanges that you mentioned to just get big clients and partner with the biggest exchanges, so when they do staking, they're actually using Ankr on the back end, and the end users aren't really aware of that?
I mean, the users, they should be aware of that. I think what happened with Celsius is maybe the lack of transparency was an issue from those providers. So I think making sure that you can offer integration solutions that are fully on chain, it also allows it to be fully transparent. And I think using liquid staking allows it to make it fully transparent instead of using other solutions where you cannot really offer that kind of transparency when you have manual processes in between, such as manually handling delegate staking and doing the node management yourself. In terms of partnerships, so obviously we believe that it is more cost efficient for us to partner with companies that already have a large user base that doesn't necessarily want to interact directly with DeFi, to use indirectly liquid staking from us instead of us giving away very aggressive farming rewards. Because in that competitive landscape, I will say our competitors, they're just doing liquid staking. We're doing much more than that. So we need to be a bit more responsible about how we give away our Ankr tokens, and we cannot really fight in the same space of rewards, right? However, we do have, I think, the credibility of being a full-fledged infrastructure provider, and I think that can play a big weight for those integrators that might want to start interacting with liquid staking, and I think they will rather partner with Ankr than new liquid staking providers that came up only a few months ago.
And what do you see, Filipe, as being the key factor to success for during the next bull run, and let's just say 2 years from now, for Ankr to continue to be the #1 liquid staking solution?
So I think the liquid staking is not necessarily the core product of Ankr, right? I think really our core business is about building developer tools, and obviously the RPC nodes is a main component. I think what really makes sense for us is to potentially expand to different type of nodes where we offer synergies for developers. So I think what we really would like to see in the next 2 years is that every builder in DeFi, in Web3, is in some way or another using Ankr tools, which can be gaming, it can be creating their own sidechains with the help of Ankr, it could be the RPC nodes or other type of nodes eventually in the future. Liquid staking is a great tangible product for non-developers. I think it provides a lot of branding awareness about Ankr as well. And what we see very often with new chains that want to integrate and have their chains supported by our RPC node network is that they have very often now liquid staking, which is something that was not happening 1 year ago. So when you create your own blockchain, usually it always starts with we need RPC node providers so that builders can build on my chain, and APIs, and we need the blockchain explorer, and so on and so forth. And very often the part of liquid staking happens because it's a great way for them to bootstrap their own liquidity, right? Because if you have BNB chain 80% that is staked, I mean, it's nice, but it's not counting as TVL on your chain unless you're using liquid staking. If you're using it as liquid staking, well, then it becomes as a first layer of TVL for your own chain. And if you then build other use cases using liquid staking, that kind of multiplies TVL, which is a nice kind of growth hack that most of the chains are becoming aware of. And the new chains are willing then to integrate liquid staking very early on.
Great perspective, Filipe, and thank you for explaining that. And now, if there are users that are interested in learning more about running nodes or blockchain projects and institutions that are and developers that are looking to look into Ankr's development tools, what is the best way for them to learn more about that?
I will say it will be to contact us through Discord. So that's usually where our developer community is more active. So I will say that running a RPC node, for example, if you're really experienced into that field, you can definitely try it out. And it is still not a fully automated, open, permissionless access, but you can definitely get in touch with our team, and we can assess the request.
Sounds great, Filipe. Thank you so much for all the insights into the RPC nodes and the liquid staking and developer tools. And I really believe that development and infrastructure needs to come first. Otherwise, there won't be anything for the end users to use. So I'm glad that your team is working on that. I will leave the link to the Discord and the platform in the description box below as well. Thank you so much for all your insights, and let's follow up in the near future.
Thank you. Have a nice day.